Hello and welcome to another video. So the question today is, why do people not like to own buy-to-let property in a personal name? Over the past few years, there's been some changes to the tax system, and now owning property in your own personal name just isn't very good. But why is that? I want to have a look at it with my normal spreadsheet examples that I've made before the video, and hopefully that will give you a really good idea why in most cases buying in your personal name a buy-to-let property doesn't make sense. I'll also talk about the potential situations where you might still want to do it, but let's get into it. So in the middle here, as you can see, is the Scottish tax system. Personally, I don't like it. What happens is at the early stage of your income or career, it's very favourable. So when you earn up to £12,570, you actually don't pay any tax. Fantastic. Then your salary goes up 12,571 to 15,397. You're only paying 19% on that little bit, which is what, a couple of thousand. Great. You then become a basic rate taxpayer, so you earn up to £27,481. Again, between the 15 and the 27, you pay 20%. So again, no big deal. Then you get slightly above that, so from 27 to 43, you pay 21%. So really, first 12 grand is tax-free, then all the way up to £43,000, you're paying reasonable tax, around 20%. That's quite good. The problems really begin when you become a higher rate taxpayer. So in this country, they want us to become engineers, doctors, and all of those highly skilled professions. But what you realize is as you progress through your career ladder, as you get below that 43k, you're going into the 42% tax bracket, and that's an absolute killer. So at the higher rate taxpayer, 43 to 75k, you're paying 42%. So in that range or that space between your tax and your national insurance, you're giving away half of your income. So if you get a pay rise when you're at 50k, you get a pay rise of 10k, it's actually only 5k because 5 of it goes straight to the government. Then when you make it to £75,000, all the way up to 125, it goes up to 45%. So that's a lot of money. And then above £125,000, you start losing your personal allowance and you're paying 48%. So it's an absolute robbery. Why am I talking about income tax? Well, if you own a property in your personal name, the income from that property actually counts towards your taxable income. So those are the brackets that you're going to be in for paying that tax. So what that means is that if you are, for example, earning £25,000, you are essentially leaving yourself a gap. You're up to that £43,000. As I said, you're okay. You can manage the taxes, not too bad. If you earn a relatively modest salary of £25,000, you've got that 18 grand gap where you can own a property and it can generate your rental income. And then that can be, as long as it doesn't exceed in total 43,000, you might be okay. But as you progress with your £35,000, that gap that you have is now quite limited. It's only 8,000. And say you're now 45,000, £55,000, it actually shows up as negative. So what that means is that you'll be straight into the higher rate tax with your property income, and you don't want to be there. Who wants to be renting a property, doing all the work with repairs, hassle with tenants, etc., getting your rental income and half of it disappearing into the skies, into the government? It's not ideal. So because of those income tax brackets, people don't really want to own property in their personal name. That's the first thing. The second thing is this law that was introduced that essentially said that you're not allowed to fully claim your interest on the mortgage as an expense. That is absolutely ridiculous, but they're saying it's not an expense, and I think currently you can claim 20% of that interest, mortgage interest, so a fifth of it, and I think that's going to potentially change in the future. So that is really, really bad. What that means is that if you're a cash buyer and you have a low salary, which is quite an unlikely situation, if you're making 25 grand a year, it's going to be very hard for you to save up 100 grand or more to save up to buy a decent house or a flat. So if you are a cash buyer with a low salary, it might work for you. However, if you are buying with a mortgage, a buy-to-let mortgage, potentially interest only, you will only be able to claim a small part of the mortgage interest as an expense, and that is really bad. So to give you an example here, just have a look. Just imagine property values 50k, 100k, 200k, 300k, 400k, assuming the rent is around 8%. So after your expenses, your legitimate expenses such as repairs, insurance, etc., you are making 4 grand a year, 8 grand a year, 16 grand a year, depending on the property value. Your mortgage, your interest-only mortgage payment for the year is £2,500, £5,000, £10,000. So the higher the property value, the more the rent and the more the mortgage you have to pay. So your pre-tax profit is £1,500 for a £50,000 property, £3,000 for a £100,000 property, and so on and so forth. However, the tax gets taxed on the rent minus just 20% of the interest on the mortgage, not the full mortgage. What that means is that you have a high tax obligation to pay on this. So for a 50k property, you will be left with £30 a year, not a month, a year profit. 100k, you'll potentially be left with £60. And for 400k property, £240. So even without worrying about this high rate tax, you are getting absolutely shafted. You are getting really badly hurt with this example. This rule is absolutely ridiculous. I don't agree with it at all. The way to get around it is to open a limited company and invest in a limited company, which is what most people are doing. But this is a big reason why people don't like having the properties in their own personal name. Now, is that the case all the time? Can there be anything at all that will make you want to own a flat in your personal name? And I think the answer is yes. So, for example, one is there's a possibility for lower stamp duty. So if you are buying a flat below a certain value, you might, for example, buy a flat for personal use, so just a 10% deposit, and then later on realize that you're going to move out of it and get a permission to rent. So then you've got an asset with a very low deposit that you're now renting out. And if you've got low income, it might work well for you. If you've got lower or no income, again, that can work relatively well because you've got that 12 grand allowance that can potentially work in your favor, especially for the cash deals. I think for the mortgage deals, it's just not good. It needs to be more of a sort of cheaper cash deals potentially. You're going to get slightly better mortgage rates in your personal name. So in the company name, in a limited company, they're slightly higher. There's more arrangement fees, so you can get it cheaper in your personal name. There's maybe easier admin. All you have to do is just submit a self-assessment, whereas with a company, you have to do the documents to form the company, and then you have to file your account every year, potentially get an accountant in place. So what you need to think about if you're considering buying an investment property in your own personal name is, what is your long-term plan? What are you looking to achieve? Then also, do you own any property already? So is this the first property that you're going to be buying, which is where you might benefit from the lower stamp duty? Or is this a second, third, fourth property where the tax is the same? Is your salary likely to increase? Because right now you might think, oh, I'm working part-time, I'm making 15 grand a year, so I've got plenty of room for the rental income to come in and it's going to be fine. And that might be the case, if you've got a very low income, you have inherited a property, or you've bought a property cash, You're now getting that rental income, you've got the room, you're only paying 20% tax, you don't need all the hassle, it works, that's fine. However, something changes in your life, you're no longer part-time, you get offered a manager's position, you get promoted, you're now at 40 grand a year, and all of a sudden you don't have any room to be claiming any of the rental income. So just have a think about where your life is likely going to go to. Next is, do you want to build up property income and quit your job? So potentially you might buy some property, you might take a hit with the tax, but you will know actually what I'm going to do is I'm going to buy a few of those properties, 2-3 properties, but in 2 years time I'm going to quit my job and I'm going to go traveling and I'm going to live off the property income forever because I don't need that much. Maybe that's the case for you, in which case it would work. So just have a think about that long-term plan. That's what it always comes back to. Another thing is, what are your typical expenses and likely profit? So, for example, you might want to buy a property, rent it out, but every year you will be putting a lot into maintenance, a lot into repairs. And as long as you need to be careful about needing to capitalize some of the repairs, so it's a like-for-like replacements. But if you know you're going to be putting money back into the property and you're going to be left with zero tax, and for some reason that is beneficial to you and that's within your plans, then this one might work, because your property is going to have legitimate expenses, it's going to have rent coming in, it's going to have legitimate expenses, it's going to have zero or negative tax, and then that might work for you. I'm not 100% sure what the reason for that might be, but it depends on the personal circumstances. So just think about typical expenses and the profit that you're likely going to have, and then your long-term plan, because it might be the case that you're going to be investing into the maintaining the property quite a bit for a couple of years, then you quit your job, and then you can now start taking your income from the property. So it's complicated, but just something to think about. Well, this is spelled wrong. This should be permission, but that's what I've talked about before. So actually, with a personal name, what you can do is you can buy a flat for yourself. So if you're maybe living with parents or whatever it might be, you might buy a flat for yourself. You will be paying lower stamp duty and lower taxes, or potentially no taxes at all. You then move into that flat, you live in it, and then after a while you realize, you know what, I'm going to go back to living with my parents, I'm going to go away for a bit, and I want to rent it out for a year. So then you explain that situation to your mortgage provider, if you have a mortgage, and then they will potentially tell you, yes, that's fine, you can go and do that. So in that case, you're still paying your mortgage. You don't need to, it's not interest only, it's just your expenses, something that you're used to. But you're now getting this rental income coming in, and potentially that's something that works for you. You have put down a low deposit, and it helped you get into this investment without the 25% deposit that you typically need for a buy-to-let company. So I hope this makes sense. Buying in your personal name is not ideal. I'll do another video on buying in a limited company, pros and cons of that. But hopefully with this video, you can see that one is this not being allowed to claim your full mortgage interest as an expense. That's a big killer for this personal name property. And the second thing is the income tax rate in Scotland. That's another big killer. When you get above that 43k, you're going to be paying an absolute fortune for all those things. There are also possible benefits, such as lower stamp duty. If you have some interesting plan with your life where you might take a hit, but later on you're quitting your job, you're not having income, so you can start taking more out. There are things that could happen there. I think also there's some things around flips. So if you want to buy and then sell, if you do it in your personal name, again, there might be, if you're living in it during the refurb, you might benefit from the capital gains relief. So there are a few things to consider, but in most cases, as you're scaling up a big portfolio, that wouldn't be for you. So I hope this gives you a good understanding of pros and cons, and looking forward to seeing you in the next video, which is going to be similar, but about a limited company. Thanks all.